recipes for technical trading success in Cook's Kitchen.
Did you hear the one about the number that killed us? That's actually the name of a book that I'm reading right now by Pablo Triana, a quant who's looking back at the financial crisis and trying to explain it. And that number he's talking about it is VAR, value at risk. It's a boring book. I don't recommend it. It's much more fun to watch this movie, The Big Short, based on Michael Lewis's book that explains what happened in the subprime housing crisis that created a meltdown on Wall Street and nearly broke our economy, hurting millions of people. I love the film. I think they did a great job of telling a very complicated story. And, so just some amazing performances, I thought, too. Christian Bale as Michael Burry. Michael Burry was a real guy who, wanted to short this housing crisis. I hear he even likes Christian Bale's performance, and they spent some time together before the movie helping Christian prepare for the role. Who else was really interesting? Obviously, they had to spice it up a little bit, make the education of complex topics interesting, so they brought in Margot Robbie. That didn't hurt. I'm glad the whole movie wasn't like that, though. It was a unique storytelling style, and I think they did it well. Ryan Gosling was terrific as the seemingly predatory banker from Deutsche Bank. And I don't know if the character that he played, if in real life the guy from Deutsche Bank used the Jenga game model to explain, these derivatives, the CDOs, and the subprime tranches with bad credit ratings, C-rated stuff being thrown in with the A's, and how that was a whole Jenga tower. If that banker from Deutsche really used a Jenga model to explain this to others, it was pure genius at the time. And if they just adapted it for the movie, I don't know. So if you know, write me, leave a comment on this video, and let's figure that out. Steve Carell, I thought he was great too. Playing, his character's name was Baum, but the real-life character he was based on was Steve Eisman, who, just like Michael Burry, saw what was going wrong in subprime housing and the derivatives that were being created, and he was very serious about it. And some of these guys are portrayed as heroes because they realized what was up on Wall Street, but they portrayed Baum's character, Steve Carell's character, as not being very happy about what he was involved with, and I think that's probably true of Steve Eisman as well. All right, so how well did Michael Lewis and director Adam McKay of the film tell the subprime housing story? I'm going to give you 10 quick bullets of stuff they covered and how well they did it. They introduced the idea of mortgage-backed securities, MBS, and how they became corrupted. They explained how the Wall Street bond market worked to securitize mortgage-backed securities, and that's a whole machinery that made their life easy to do it. And then the CDO, the collateralized debt obligation. Now, this is what first blew up in the summer of 2007. Bear Stearns had a couple of hedge funds that were built around CDOs. Those failed, and the first rumblings of the crisis began. I was very fortunate in early 2008 to start working for a large options trading firm in Chicago, where I basically had a ringside seat at watching the institutional banks collapse. In fact, in March of 2008, I watched Bear Stearns collapse. We'll get to that in a minute. So what did Wall Street do? There was continuous repackaging of the subprime securities into what I would call elaborate monstrosities of junk. And the rating agencies were complicit in the greed and the ignorance via stamping things with a AAA rating. And I think the movie did a good job of showing that. Hey, what was their incentive? They're getting paid by the banks. Do they want to sell more ratings and help sell more bonds and package securities? Then if they do, they give a more favorable rating. The tricky part is that the banks were giving them the model that they should use to rate the securities, even if they were full of subprime junk. All right, so who are the buyers of this junk? This is kind of an important question. If somebody created this CDO full of all kinds of junk security, junk paper, so to speak, but rated at AAA, who was actually buying it? Well, insurance companies, foreign banks, other hedge funds, obviously Bear Stearns, and pension funds. Why? Because they were told it had a AAA rating, so everything was good, and they were getting a decent return. So everything seems fine. I can tell my investors it's we're getting this return, AAA securities, everything's cool. Then comes in the credit default swap, which was basically an insurance policy on this junk paper. And that became instrumental in the implosion of Bear Stearns, because as you saw if you saw the film, and you should see the film because it's done really well. So the characters, Michael Burry, Steve Eisman, Steve Carell's character, they would go to banks and say, please give me a way to short these securities. And what the banks came up with was a credit default swap, which is basically an insurance policy. So, but that created a spiral loop. And, so it's arguable whether, some critics of the movie think that, hey, these guys weren't all heroes because creating that spiral loop of credit default swaps against CDOs, and Goldman Sachs was implicit there too, it helped fuel the meltdown of the banks on Wall Street and intensified the crisis for the whole economy. Obviously, multiple factors created the real estate bubble and the economic collapse. So the movie couldn't get into all of them. I certainly can't in this 10-minute video. And I've already asked this question. Critics of the movie say, in Michael's book, were they really heroes? And what about Goldman's involvement? We don't even have time to talk about all that now. So let's get to VAR. I introduced VAR in the beginning. This is the real underlying cause of Wall Street's doomsday machine. Doomsday machine was the language that Michael Lewis used as the subtitle to his book, The Big Short. So the bell curve model of value at risk. Well, the bell curve, it. It's, you took probability and statistics in college. You know what standard deviation is. Here's your bell curve. It takes data and assembles it to find, what's the average? What's the most likely occurrence? One standard deviation either side of the average, and so on. So what you also know about standard deviation and the bell curve is that it has tails where outlier events happen. I borrowed this chart from Carl Richards. He runs a site called behaviorgap.com. I highly recommend checking him out. He's actually a certified financial planner, but he's intensely interested in people's behavior. And so, of course, he looks at things like standard deviation. So I wrote this article in 2012 called Supermodels with Fat Tails. And you can look it up on Zacks.com or NASDAQ.com. May of 2012 I wrote it. So there's your fat tails. This is what happens in a so-called normal distribution is you get those outlier events that are only supposed to occur in less than 5% of cases. Or even further out, the 100-year flood, so to speak, that we talk of. Well, how often do 100-year floods actually happen in the stock market to cause, extreme price moves where something you thought could never happen, 1 in a million chance actually happens? Well, that's where Wall Street goes wrong, using standard deviation to model risk. Now, who's the guy who actually thought of all this beforehand and predicted the crisis? Nassim Taleb in The Black Swan. He published this in early 2007. He'd been working on these ideas since at least 2001 when he wrote Fooled by Randomness. And so in early 2007, this comes out, and this is an indictment of the bell curve and standard deviation as risk models for Wall Street and creating things like value at risk, which is based on just simply standard deviation in the bell curve. So this book is definitely worth reading if you have the time, because he won't take credit for predicting the crisis, because one of his definitions of a black swan is that it can't be predicted. I wrote a review of The Black Swan in the summer of 2008. I actually wrote it in the spring, but it was published in the summer of 2008 after Bear Stearns' collapse in this magazine, SFO. This magazine no longer exists because the publisher is in jail for financial fraud a la Bernie Madoff. But anyway, I've got to find a way to get my book review digitized and put it somewhere on a blog or something. Anyway, what are the key ideas from Taleb that he tried to teach us? Gauss created standard deviation along with a few other mathematicians, a couple hundred years ago. And what was their point? It was to measure variation in normal physical phenomena. So things like height and weight and chemistry, biology. So SD, standard deviation, and the bell curve help us see and predict the average of things like a person's height or weight. Biology, physics, chemistry. Its standard deviation is incredibly useful in all these places. But what Taleb warned us about is that it's built on past data. What happened becomes equal to predicting a future probability. The problem is that markets are social beasts, cultural beasts, human behavior, rules, and it creates infinite complexity and infinite variance. So most things that standard deviation works great for don't have infinite variance and complexity. They tend to have averages. So applying a model about averages to a field where anything can happen creates a very dangerous model. Taleb calls it wild randomness, where, hey, not only are the tails fatter, but they come in sooner, so a lot more can happen. After I read Taleb, I started summing up that when anything can happen, there is no standard for deviation. So that's my presentation. Lot to talk about there. We could go on for hours, and I'm happy to discuss it more. Find me on Twitter @KevinBCook. Happy to come and speak to your company or your university and give a more detailed presentation with all the stories that go with it, from watching Bear Stearns collapse to seeing the reactions here in the community as we learn, in the financial community, as we learn about how Wall Street took some models, hey, that work great for a lot of other things, and thought they could define the risk of incredibly complex instruments and human behavior, which is sometimes very often unpredictable. All right, thanks for joining me in the kitchen. I'm Kevin Cook.